The first 6 months or so of this year saw a relatively healthy recovery in precious metals. In turn, through leverage, this saw a far bigger rise in the share price of those in the sector that are producing the likes of gold and silver. Angelos Damaskos is the fund manager of the Junior Gold Fund, which specialises in small cap players in the gold and silver space. He joins us now. Angelos, welcome. In fact, congratulations, because I understand that Morningstar has your fund as, I think in all categories, the best performing gold and silver fund year to date this year.
That's right.
How have you done
we are delighted. Well, I like to say that our strategy was developed in the trenches through the dark days of the bear market, particularly in the last couple of years, because we were very keen to shore up value and maintain the portfolio holdings that were sustainable operations and would survive the downturn. So we focused on those companies that had cost control as the #1 priority item on their agenda and restructuring of the balance sheet as the other. So those companies reduced their debt, wrote off the legacy ambitious assets, concentrated on running cost-effective operation. And naturally, these are the companies that see the largest margin expansion as the gold price rises. So, and investors realize their relative value and safety and reward them with a significantly higher share price rating.
Okay, let's take a look first of all at the weekly gold price. We can see at the moment that we're around about the 1,350 level for weekly gold. This is, you can see in the context of the declines you were talking about over the last couple of years or so, and the recovery that we've seen. I think if you go from the bottom to the top in this latest move, we've got about 30% rise or something, but your fund is up over, at the bottom to the top, I think this year is at what, 200% or something, is that right?
Well, it's 203% today, year to date. From the bottom in January is up 235% or so. So massive re-rating.
It's amazing actually, that leverage system, the way it works out. Let's take a look if we can. I think we've got a list of your top 10 holdings. Just talk us through what you've got in terms of the companies here. Some I know that some retail investors may not be aware of. Not all trade in the UK. In fact, you've got many, of course, trading in other jurisdictions. I think the bottom line is you go for safe jurisdictions, don't you?
Yes, absolutely. We have always avoided political risk. We don't invest in Russia, the former CIS countries, other politically unstable territories. And naturally, we have concentrated in Canada, Australia, and some select countries in Latin America, like Colombia and Peru, as being the top jurisdictions. And of course, Mexico for silver producers, which is the top producing country for silver. But most of the fund's portfolio is invested in Canadian listed companies, more than 50%, and the balance is primarily Australian, with a very small percentage, less than 10% in UK listed companies. And this is primarily because we see a much bigger universe of companies in those larger markets for mining, particularly for precious metals mining stocks, and therefore we have a much greater selection.
Of this list here, pick out a couple of stocks you want to talk about, because clearly, I mean, they generally speaking, these stocks, as we say, are doing very well this year. Yeah. What are you focusing in on, particularly as a fund manager, in terms of these top 10?
Well, I'm focusing now, I'm trying to now think what is the next step. We have seen a massive re-rating in the producers that have cut costs, as I said earlier, have restructured their balance sheets and are moving forward with very prudent operations. But I'm trying to think what is the next step as the gold price develops. And I think the next value driver will be for those companies that have significant resources to move into production in the near term. And I don't mean out-and-out exploration, which are projects that will take 3 or 4 or 5 years to come to production. I'm talking about resources that are within the vicinity of existing operations and can be added on to grow production very quickly and relatively cost-effectively. So these are the companies that we're focusing now. We have added significantly to the position in the last month or so of Doré Minerals, which is an Australian focused producer. It operates 2 mines in southwestern Australia. One is underground, one is open pit. And in particular, the open pit mine was acquired in the middle of 2015 at the depths of the market, and they paid very little for it. And it was a mine under near-term development financing plan that the previous owner could not finance. And they have completed the mine within budget and within schedule. They have started production earlier this year. And I believe now Dori, from currently producing about, last year they produced 84,000 ounces. Next year they expect to produce at least 130 and possibly more because of this new mining operation coming on stream. And in the meantime, they are lowering their costs significantly because of economies of scale. So I think they are going to see a significant expansion in their profitability and earnings, and therefore a very attractive re-rating potential.
What's your second pick?
Another one that I have added to recently is a company called Kings Rose Mining, and that's an Australian listed company that operates a mine in Indonesia, in Sumatra, called the Talang Santo mine. And they have suffered tremendously from watering problems. There was a significant water ingress into the mine, and the previous management could not get it under control to manage the operations effectively. Now, they have recently restructured the management team. The top manager has gone. They have replaced him with other people very competent, and they have gotten on top of this dewatering process. And I think the results are going to appear in the bottom line in the short term, in the next 6 months. It's a very high-grade mine. Potentially, if they control this issue, they could produce at a very low cost. At the moment, they expect that the all-in sustaining cost for the next year will be around $1,300 an ounce, so pretty much where we are now. But the cash costs are significantly lower, less than 900. So, and I think with this issue being under control, they will improve profitability very dramatically.
Okay, give us a couple of picks there. Just give us some more context about where you see things moving. You've also supplied to us, which we're going to bring up in a moment, just ETF funds. There's a lot of money going into ETFs. Yes. These are exchange-traded funds in both gold and silver. And at the same time, I think another chart that you've got which shows that the gold to oil price is at highs not seen for a number. Right. Just read these for us and interpret these in terms of where you think the price of gold is going.
Well, as we have discussed before, we have seen a massive change in sentiment towards gold and precious metals since the beginning of the year. In middle of January, something happened and investors focused again on gold as a safe haven. And since then, the ETF holdings of gold and silver have been climbing steadily to much higher levels. And you can see from the charts that the climb has not stopped. It has had a slight pause in the end of August, but now we see a build-up again in the beginning of September. So there is clearly a very keen interest among global investors to diversify their portfolios to a store of value, and gold and silver are the number 1 and 2 sort of source of value. At the same time, we monitor many indicators and many technical and fundamental drivers of precious metals as well as economic indicators. And one ratio that has caught our eye recently is the so-called gold to oil ratio. And what that ratio means is how many barrels of oil an ounce of gold can buy at any point in time. And if you look at the development of this ratio over the last 15 years, it has consistently spiked up at times of financial crisis. So you see a significant spike up in the dot-com crash, 2000-2001, then a much bigger spike in the global financial crisis, 2008-2009. And now we are well above those levels. This ratio has risen significantly higher to those two previous crises. Now, of course, it's a ratio, and because oil has taken such a big hit in the last 2 years, it's down more than 60% off its highs, it means that an ounce of gold can buy a lot more oil. So it's one of the explanations of this ratio going significantly higher. But generally speaking, this is a ratio that shows that the global investors are frightened. They are buying into gold as a safe haven and push each price higher, and at the same time they don't buy basic commodities, valuable commodities such as oil, which are everyday traded commodities and are very important for the global economy. So it could point to a financial stress in the world. that might not necessarily appear in the very short term, but it does point to something.
But at the same, as a background to this, some of your peers in the fund management industry are doing very well out of ordinary stocks and the ordinary markets, which are reaching record highs, technology, utilities, other. It does seem strange that everything is going up at the same time.
Well, yes, I think it has been very interesting to see the global markets rebound of the sell-off we saw in February, March, earlier this year. And again, we believe that the markets are propped by the quantitative easing. Historically low interest rates, negative rates in the Eurozone. People have to pay the bank to keep cash on deposit. So rather than keep the money at the bank and pay money for it, they invest in the global stocks, hoping that the quantitative easing and the actions of the central banks will help the economy, and ultimately we will see stronger growth. I think personally, and I have maintained this for a while, that the global markets are overvalued on this premise, and anything that could destabilize the confidence of investors could lead into a massive sell-off.
Yeah. You looking forward to the next 4 or 5 months for your fund, the Junior Gold Fund?
Yes, as I see the ETF holdings build, I believe the gold price is very firmly supported, and so is silver for that matter. So on the back of stronger commodity prices, all of these producing companies are making significantly bigger profits. So now we are trying to screen all the universe of producing companies and find which are the ones that are relatively undervalued at this stage, have not risen with the rest of the market, and are set for a significant re-rating.
Oh, good luck with everything. Angelos, in the meantime, thanks for joining us. It's Angelos Damaskos, who's the fund manager of the Junior Gold Fund.